On Wednesday, May 13, 2026, the US Senate confirmed a new Federal Reserve chair, 54-45, the most partisan Fed chair vote in history. His name is Kevin Warsh, and today, Friday, May 15, he officially takes over the most powerful unelected job on earth. The bond market is panicking. Rate hike odds just hit 45%, and the 10-year yield spike to a one-year high, and almost nobody on Wall Street is connecting this to what I think is the most asymmetric trade on the market right now. And today I'm going to walk you through three things. First of all, who Kevin Warsh actually is and what his real policy views are and why the market is fundamentally misreading him. Why HIMS specifically out of every stock in the entire market is the cleanest expression of a rate cut trade. The beta, the multiple, the duration math, all of it. The third, three concrete scenarios, the bear, base, and bull specific price targets, real probabilities. Let's go.
Welcome to the game, it's the Instant Stocks by Mikhail Kuhar.
And if this is the first time on my channel, welcome. My name is Mikhail and I cover stocks that can 5, 10x and possibly even more in the coming years. And over the last 4.5 years, we have developed a software that allows our team of professional day traders to trade through your Interactive Brokers account completely hands-off. And the great thing is the cash stays in your account the whole time, which means you can be liquid at the end of every single day because 95% of the trades we take are same day trades. We shoot for anywhere from 5 to 15% returns every single month. And over the last 7-month run, we had a 25% return from September until March. And one of the reasons we built this because we understand traders are busy. You probably have a business, a family. That is a cat on my screen. You probably has a business or family, or you may have tried signal trading groups before. And the problem is you're busy. You're not at the screen. You can't catch the trades. You FOMO buy, you chase losses, or you just completely miss the trade and try to enter at a different point. We take care of the entire process for you. So all you need to do, switch the software on before the market opens and then do that every single day and you are good to go. Here's some results from some of our clients recently, and here's some results from a client who actually bought a house off the back end of our team's advice on stocks on YouTube. Now, if you're looking to triple your portfolio in the next few months, we are not the people for you. Have we added 30% to people's portfolio in 1 month? Yes, we have. Have we had 5% drawdowns? Yes, we have as well. That is the reality of being in this space. And if you're looking to leverage the market when it's going down and when it's going up, and you want to have exposure in different stocks all year round, we are the place. We have a 100% money back guarantee as well. So click the link below or go to x10daytrade.com, book a call with myself. I'll walk you through the entire process and show you what we're doing right now. And we're about to launch version 3 of our AutoPilot software. When we do that, spots will be limited, price will be going up, and the results will be going up as well. Without further ado, without cats on the screen, let's get stuck into today's video. So first of all, let's zoom out. Let's look at the entire timeline. Late 2025, months of public pressure on Powell to cut rates. April 21, Warsh's confirmation hearing. He denies being Trump's sock puppet, says he will exercise independent judgment. I think that's a lot easier than said in these positions, but we will see. May 13th, the Senate confirms him 54-45. Only one Democrat crosses the aisle. May 15th, 2 days ago, Powell's last day. Now look at the macro setup below. 4 numbers really tell this whole story. 4.55%, the 10-year Treasury yield right now, a 1-year high. 45%, the probability the market is pricing for a Fed rate hike in 2026. A month ago, that number was 1%. 3.8%, April 2026 CPI, a 3-year high driven by the US-Israeli war with Iran and the energy spike that came with it. 53x, HIMS forward PE, one of the most rate-sensitive multiples in the market. That in itself is the setup. Now, let me explain who Warsh actually is, because I've seen financial outlets getting this wrong. He's 56 years old, a Stanford undergrad, Harvard Law. In 2006, at 35, he became the youngest Fed governor in history. He served from 2006 to 2011, which means he was inside the Fed for the entire global financial crisis. He watched Bernanke design quantitative easing from the inside. After leaving in 2011, he spent 15 years at the Hoover Institution writing about what he sees as the structural problems of the modern Fed. He has a long published record, and that record tells a very different story from the one the media is starting to spin. Financial media calls him a dove because Trump wants rates cuts. That is lazy analysis. If you actually read Warsh's published work, his views are more nuanced. Yes, he has consistently argued the Fed has been too slow to cut rates when inflation comes down. He has said there is room to lower rates from current levels, but he is deeply hawkish on the Fed's $6.7 trillion balance sheet. He thinks quantitative easing went too far and stayed too long. He wants to shrink that balance sheet aggressively while potentially cutting the policy rate at the same time. That combination has never been tried before, and the net effect for growth stocks is still positive because the policy rate is what drives the discount rate, which determines equity multiples. There is also Warsh's institutional agenda. He wants to cut the Federal Open Market Committee meetings from 8 per year to as few as 4. Fewer press conferences, less forward guidance, less hint giving. A Fed that communicates less and intervenes less is a Fed that forces the market to pay attention to actual company fundamentals. For a company like HIMS that is genuinely executing, raising guidance, growing subscribers, reaffirming 2030 targets, that is a net positive, regardless of what happens to rates. Now, one of the key questions behind this is, will Warsh actually cut? Nobody knows for certain, but the evidence points towards yes. Eventually. The April CPI of 3.8% sounds scary, but almost all of that elevation is energy. Strip out energy and core, CPI is running closer to 2.5%. Warsh has argued publicly that the Fed should look through commodity-driven shocks because the Fed cannot control oil prices. If he applies his own framework, he sees core inflation moderating and concludes there is no room to cut even while headline CPI looks elevated. Add the political reality. Trump appointed Warsh specifically because Trump wants cuts. And both Warsh's genuine beliefs and the environment he operates in push that same direction. Look, the base case would be Warsh eventually cuts, but just not as fast as Trump wants. Now, the bond market right now is priced for one scenario. Persistent inflation, no cuts, possible hikes, permanent geopolitical risk premium is there. And I think that consensus is wrong on the most important input. Markets are bad at pricing mean reversion. The Iran war dominating headlines, so markets assume it continues forever. Oil prices spiking, so markets assume they stay elevated indefinitely. Inflation elevated, so markets assume it just never normalizes. But wars end. Commodity shocks do normalize. Energy-driven CPI spikes revert once the underlying cause is resolved. None of these base rates are reflected in a 45% rate hike probability. That is the mispricing itself. Now, the market is not wrong to be cautious. It is wrong to price the permanent version of a temporary condition. And when that condition normalizes, when Iran de-escalates, when oil falls, when core CPI continues its gradual path toward market, the bond market reprices fast. The 10-year falls, rate hike odds collapse, risk assets snap back, and the stocks that snap back hardest are the ones with the highest rate sensitivity. High beta, high multiples, long duration cash flows. But why HIMS specifically? If we look at this chart, the estimated impact of a 50 basis point rate cut on different types of stock. SPY 5%, QQQ up around 7%, mature tech up around 8%, and then we look at high growth tech up around 14%. HIMS an estimated 22%, more than 4 times the impact of the SPY. But why is this? There's 4 specific reasons in how we get to this. Number 1 is a high beta of 2.43. See, HIMS moves 2.4 times the market in either direction. If a rate cut sends the S&P up 10%, HIMS moves roughly 24% from beta alone. The second is a high forward PE of 53x. Higher multiples are more rate sensitive. When the discount rate drops, high multiple stocks expand disproportionately. When rates were near zero in 2021, HIMS traded at multiples far above where it sits today. And that compression can reverse. The third part is just long duration cash flow. Most of HIMS' projected value is in cash flows that materialize in 2028, 2029, 2030 and beyond. Management's 2030 revenue target is $6.5 billion. I would not be surprised if they raise that guidance in the coming years. Their 2030 EBITDA target is $1.3 billion. Current 2026 guidance itself is $2.8 to $3 billion. The bulk of the company's value is 4 to 10 years out. Long duration cash flows are the most sensitive to discount rate changes. Mathematically, a 1 percentage point rate drop affects a 2030 cash flow far more than a 26 cash flow. And the fourth one is it's just already deeply discounted. HIMS is trading at around $25. The 52-week high is $70.43. The stock is down over 60% from recent highs, and most of the rate-driven multiple compression has already happened. The bad news is in the price. Limited downside because the bears have already won the last 12 months. Asymmetric upside because none of the good news is priced in yet. Now, if we combine all four of these, high beta, high PE, long duration, already discounted. Most stocks have like one, maybe two of these characteristics. HIMS at the same time has four. That is why it is the cleanest rate cut vehicle in the market. It's why I keep going on about it. Let me make the math very concrete for you. Warsh signals openness to cuts at the June Federal Open Market Committee. The 10-year drops 50 basis points from 4.55% to 4%. S&P rallies 5 to 7% on risk on flow. HIMS beta of 2.43 translates to 12 to 17% move just from the beta. Add multiple expansions specific to long duration, high PE stocks, another 5 to 8%. Total estimated move could be anywhere from 15 to 25%. On HIMS at $25, that is a move from $28 to $31 in a single meeting signal. Not an actual cut, just a signal, no extend further. Warsh actually cuts 50 basis points by year-end 2026. S&P rallies 15% over the period. HIMS beta-driven move approximately 36%. Additional multiple expansion 10 to 15%. Total move 45 to 50%. On HIMS at $25, that is a move to $36 to $37 from macro alone. And that assumes zero improvement at HIMS operationally. Same revenue, same EBITDA, same subscriber count. Pure macro tailwind. Now add what management has actually guided for. Q2 revenue was raised 100 million, 680 to 700 million, a 12 to 15% sequential growth. H2 EBITDA meaningful step up. The CFO said it explicitly on the May 11 call. 2030 targets are reaffirmed again. If macro pivot and operational execution happen at the same time and the guidance says execution is on track, the combined upside is significantly larger than the macro-only math. There is only one more amplifier most people miss. 71 million shares short, 38% of the public float. When a heavily shorted stock catches a positive macro tailwind, short covering amplifies the move massively. Shorts losing money get forced to buy back shares. That adds mechanical buying pressure to the rally already underway. SPY doesn't have meaningful short interest. QQQ doesn't have meaningful short interest. HIMS sits in a unique sweet spot where the macro pivot and the squeeze setup compound on each other. That's 3 layers of upside at the same time. Now, it wouldn't be fair if I didn't paint both scenarios because I want to be straight with you about the risks. I like to look at this objectively, right? Risk one is Warsh could be more hawkish than his record suggests. He promised independent judgment. If his first Federal Open Market Committee statements emphasize inflation, persistence over cut, optionality, the thesis breaks early. The second is the Iran war escalates instead of de-escalating. Oil at $120 plus forces the Fed's hand regardless of Warsh's personal views. The third one is HIMS executes poorly. Q2 misses their raised guidance. H2 EBITDA step up doesn't materialize. A company-specific stumble compounds macro headwinds. Now, the Federal Open Market Committee doesn't follow Warsh's lead. He has 1 vote. The most recent meeting had the most dissenting votes in 3 decades. Even if Warsh wants to cut, he needs a majority. The fifth risk is a tail risk nobody sees coming. Bank failure, sovereign debt crisis, a geopolitical shock from an unexpected direction. The same high beta that makes HIMS a compelling rate cut vehicle makes it a brutal in a broad market sell-off. If the S&P drops 20% on something unrelated to rates, HIMS drops 48% from beta alone. I'd be happy with that. I'd be okay with that. I'd just be taking more positions. So, but for you, you really need to be sizing positions accordingly. A bunch of you guys have been asking me like prices and predictions and timelines in the comments. It is very hard to answer a question when the question is so broad. You need to be very aware of your thesis. You need to know exactly where your stop losses are. You need to know exactly what your plan is, when you want to get out, how much you want to trim, if you want to trim, how long you want to stay in this for. You cannot ask someone what a good price is because it is completely subjective to your thesis and your plan inside. Have you got options? Are you planning to hit 100, 70, 40? Are you looking for it to come back to 15, 10? I'm unsure what your plan is. If you don't know what your plan is, that is the first thing you need to have in place. Have that very, very clear, and no matter what happens to the market, follow it through. Appreciate you all, as always, for my homies hanging out to the end. As always, I'll see you in a video tomorrow.